It wasn't a clerical error, it wasn't a seasonal adjustment, it wasn't even a precautionary measure, it was a structural fracture on January 2nd. While the world was recovering from the holiday season, the internal plumbing of the U.S. banking system sprang a leak. New data buried in the back pages of regulatory filings reveals that the Federal Reserve quietly opened a $24 billion credit line to three specific institutions. This didn't happen on a chaotic Friday afternoon, it happened at the very start of the year. The timing is deliberate, the amount is specific, the implications are unambiguous. Most observers look at the stock market. They look at the unemployment rate, they look at the headline CPI number, and argue about 10 basis points, but the smart money looks at the plumbing, they look at the overnight lending rates, they look at the collateral chains, they look at the desperate, quiet measures taken by central banks to keep the lights on. When a central bank opens an emergency tap of this magnitude, it is not suggesting stability. It is screaming that somewhere deep in the ledger the collateral is no longer good, the arithmetic is merciless, the pattern is unmistakable. We are witnessing the early tremors of a sovereign debt crisis that has been building for 80 years. This is not a political statement. This is not a conspiracy theory. This is a mechanical reality governed by the laws of compound interest and political incentive. The system is constrained, the exits are closing, and the few who understand the mechanics of the brake are already moving. They are not guessing, they are calculating. Here is the reality that the data is shouting at us. This isn't prophecy, it's positioning under constraints. The history of financial markets is not a history of random accidents, it is a history of mathematical inevitabilities. When a political objective clashes with an economic reality, the political objective holds the line for as long as possible. It uses regulation. It uses rhetoric, it uses emergency credit lines, but eventually the economic reality overwhelms the political dam. The dam breaks, and when it breaks, wealth is not destroyed, it is transferred. It transfers from those who believe the political promise to those who calculated the economic constraint to understand what happened on January 2nd with that $24 billion lifeline. We must first understand the anatomy of a break. We must look at the most famous trade in modern history not as a story of luck, but as a blueprint of positioning. Case File 1, the Bank of England, September 1992. The setting was the exchange rate mechanism, or ERM. This was a political project designed to unify the economies of Europe before the introduction of the euro. The premise was simple: all European currencies were pegged to the German Deutschmark. The Deutschmark was the anchor. It was the gold standard of Europe, managed by the Bundesbank, an institution with a singular traumatic memory of the Weimar hyperinflation. The Bundesbank cared about one thing: sound money. They did not care about British employment. They did not care about Italian exports. They cared about the stability of the mark. Britain had joined the ERM in 1990. They entered at a rate of 295 Deutschmarks to the pound. The British government, led by John Major, staked its entire political reputation on maintaining this peg. They called it the Goldilocks economy. They promised stability, but there was a constraint. In 1990, Germany reunified. The integration of East Germany was massively expensive. To pay for it, the German government spent lavishly, creating inflationary pressure. To counter that inflation, the Bundesbank did what it was constitutionally mandated to do. It raised interest rates. It raised them aggressively. This is where the trap snapped shut, because the British pound was pegged to the mark. Britain had to import German monetary policy. If Germany raised rates to fight a boom, Britain had to raise rates too. But Britain was not in a boom, Britain was in a recession. British homeowners were drowning in variable rate mortgage. British businesses were starving for capital. The British economy needed low interest rates to breathe, but the ERM peg forced them to keep rates high to track the mark. George Soros saw the constraint. He didn't have inside information, he had a calculator. He looked at the inflation differential between London and Frankfurt. He looked at the pain threshold of the British homeowner. He reasoned that the British government had a choice: they could keep interest rates high to defend the currency and crush their own population, causing a political revolt, or they could break the peg, lower rates, and save the economy. The incentive structure was clear. Those who had kept their wealth in sterling government bonds lost a quarter of their global purchasing power. Overnight, those who had positioned themselves in physical gold or U.S. dollars preserved their wealth. The pattern was identical to 1992, an unsustainable peg, a domestic crisis, bad debts, a futile attempt to defend the currency with emergency loans, and finally the break. The constraint, the social unrest, and the banking collapse forced the hand of the state. Case File 3, the subprime short 200720008. Move forward to the modern era, the asset class changed, but the mechanics did not. The housing bubble of the mid-2000s was built on a false premise that housing prices nationally could not fall. The entire banking system was leveraged to this assumption. The constraint was the adjustable rate mortgage. Millions of Americans had taken out mortgage with low teaser rates. These rates were scheduled to reset to much higher levels after 2 or 3 years. The smart money investors like Michael Burry, Steve Eisman, and John Paulson looked at the calendar. They didn't need to predict the future, they just looked at the loan documents. They saw that in 2007 billions of dollars of mortgage would reset. The monthly payments for millions of borrowers would double or triple. The incentive for the borrowers was to default. They had no equity. They couldn't refinance because rates were up and prices were stalling. The banks, however, were incentivized to hide this reality. They packaged the loans into complex bonds rated AA and sold them to pension funds and insurance companies. The Fed open credit line moment of this era happened in the shadows of the repo market in 2007, long before Lehman Brothers collapsed. The banks stopped trusting each other's collateral. They knew the garbage was in the system. The spread between safe government debt and interbank lending rates blew out. The smart money positioned themselves by buying credit default swaps insurance policies against the bonds failing. They were buying fire insurance on a house that was already smoldering. The establishment, the Federal Reserve, the Treasury, the bank CEOs insisted that the subprime issue was contained. They opened the term auction facility in late 2007, an emergency credit line designed to flood the banks with cash. It was the exact same playbook as the January 2nd event we are seeing today. They tried to use liquidity to solve a solvency problem. It didn't work. The arithmetic of the mortgage resets was undeniable. Borrowers couldn't pay. The bonds became worthless. The banks became insolvent. The system broke. The positioning of the few who understood the constraint generated returns of 500%, 1,000%, even higher. They didn't win because they were lucky. They won because they understood that the debt load was incompatible with the cash flow of the American homeowner. The constraint engine. What connects 1931, 1992, and 2008? It is the mechanism of the constraint engine. In every financial system, there are 3 forces that cannot be balanced forever: a fixed exchange rate or a fixed price for bonds, independent monetary policy, and free capital flow. This is the impossible trinity when a government tries to control the price of something, whether it's the price of the pound, the price of gold, or the price of the 10-year Treasury yield. It must sacrifice something else. It must sacrifice its reserves, or it must sacrifice its domestic economy. The constraint engine operates on liquidity. Liquidity is not just cash. Liquidity is the capacity of the balance sheet to absorb shock. When the Fed opens a credit line, they are injecting artificial liquidity because the natural liquidity has evaporated. Why does natural liquidity evaporate? Because the players in the system, the banks, the hedge funds, the insurers, know the collateral is bad. They stop lending, they hoard cash. This forces the central bank to become the dealer of last resort. They have to step in and take the bad collateral onto their own books in exchange for fresh cash. This is what happened on January 2nd. The $24 billion credit line is the Fed saying we will take the risk that the market refuses to take, but here is the catch: the central bank has infinite money, but it does not have infinite value. Every time they print money to fill a hole, they dilute the value of the currency. In 1931, the constraint broke the gold standard. In 1992, it broke the ERM. In 2008, it broke the private banking system and forced the state to absorb the debt. The engine is revving again. The constraints today are higher than ever. Global debt is over 300% of GDP. Interest rates have risen from 0% to 5% in the fastest hiking cycle in history. This has created a massive unrealized loss on the balance sheets of banks. They are holding trillions of dollars of low-interest bonds that are now worth 20% or 30% less than face value. If they have to sell these bonds to pay depositors, they are insolvent. That is the constraint. The incentive is for depositors to move money from low-yielding bank accounts to high-yielding money market funds. This drains the banks. The Fed must plug the hole. Mapping the pattern to the present. Let's look closely at the January 2nd signal. The next morning, September 16th, Black Wednesday, the selling began. It wasn't just Sharos. It was every bank, every hedge fund, and eventually every corporate treasurer in London. They all sold. Pounds, the British government panicked. At 1100 a.m., they raised interest rates from 10% to 12%. Think about what that means. This was an act of desperation. It was the equivalent of the January 2nd credit line, a massive, unsustainable projection of power that only revealed weakness. The market knew that the British housing market could not survive 15% interest rates. The bluff was called. The pound collapsed. Sharos made over $1 billion in a single day, but he didn't make it because he guessed. He made it because he understood that when a central bank fights the fundamental economic gravity of a nation, the central bank always loses the constraint, the pain of the British homeowner was stronger than the mandate of the currency peg. Case File 2, the Kreditanstalt and the Breaking of Gold, 1931. 60 years before Sharos, the same pattern played out on a global scale. The world was on the gold standard. The system relied on confidence and the willingness of central banks to lend to each other. During times of stress, the constraint here was the post-WI debt burden. Europe was awash in debt that could not be paid in the deflationary environment of the gold standard. In May 1931, the Kreditanstalt, the largest bank in Austria, revealed a massive hole in its balance sheet. It was the Lehman Brothers of its day. The Austrian government tried to bail it out. They guaranteed the deposits, but to pay for the bailout, they had to print Austrian shillings. They realized that the gold standard was a rigid shackle that prevented governments from printing the money needed to stop the banking collapse. If a country went off gold, it could print money, bail out its banks, and lower interest rates. But honor does not pay debts. The pound sterling was as good as gold, but the Bank of England had lent heavily to Austria and Germany. Those loans were now bad. The market realized the Bank of England was technically insolvent. Gold began to drain from the vaults in London. It flowed to Paris and New York. The British government tried to defend the peg. The pound fell 25%.
The Federal Reserve does not advertise these specific credit lines on the front page of the Wall Street Journal. They appear in the H41 release, buried in line items like loans to non-depository institutions or other credit extensions. Current data suggest the $24 billion spike was likely directed at a specific cluster of banks or a major clearinghouse that faced a sudden liquidity gap. This mirrors the term auction facility of 2007. It mirrors the swap lines of 2020. It is a patch, but look at the context. We have a commercial real estate crisis unfolding in slow motion. Office towers in major cities are selling for huge discounts, some for 50% or 60% less than they were worth 5 years ago. Who holds the debt on these buildings? Regional banks, small banks, the same banks that rely on the Fed's backstop. The pattern is matching the pre-crisis phase of 2008. Stage 1, the asset values fall. Commercial real estate. Stage 2, the lenders hide the losses, extend and pretend. Stage 3, liquidity dries up in the obscure corners of the market. Reverse repo. Stage 4, the central bank opens a quiet emergency facility. Jan 2nd, we are currently in stage 4. The smart money is looking at this $24 billion and asking, what are they patching? They are positioning for the moment the patch fails. Some economists argue that the Fed has better tools. Now they argue that facilities like the Bank Term Funding Program, BTFP, can permanently mask these losses. They say the system is robust, but here is the rebuttal. The BTFP was a temporary emergency measure. It expired. The losses remain. You cannot fix a solvency problem with a liquidity tool if a bank owes $100 and only has assets worth $80 lending it $20 cash does not fix the problem, it just delays the bankruptcy. The incentive for the Fed is to delay until something changes, maybe rate cuts, maybe a miracle. But the arithmetic of the interest payments is grinding the system down. The US government is now paying over $1 trillion a year in interest alone. This is the ultimate constraint. The sovereign itself is becoming a subprime borrower. The end games. When the constraint finally snaps, history shows us there are only 3 ways this resolves. First, the controlled decline. This is the financial repression scenario. The government keeps interest rates below the rate of inflation for a decade. They grind down the real value of the debt. Savers are slowly expropriated. The purchasing power of your money bleeds out at 5% or 7% a year, while the government claims inflation is only 3%. This was the playbook after World War II. It requires strict capital controls and a compliant banking system. Second, the chaotic collapse. This is 1931. This is 2008 without the bailout. The banks fail, deflation sets in, credit cards stop working, supply chains freeze. This is the scenario the Fed fears most, and they will print any amount of money to prevent it. Third, the reset and restructure. This is the 1992 outcome, but on a global scale, the currency peg breaks. In our case, the peg is the credibility of the US Treasury bond. The Fed eventually has to yield curve control, capping rates by printing infinite dollars. This triggers a massive devaluation of the currency against hard assets. Gold, land, commodities, and industrial capacity skyrocket in nominal terms. The debt is inflated away in a burst of high inflation. The smart money is positioning for a hybrid of the controlled decline and the reset. They are moving out of nominal paper promises, long-term bonds, cash savings, and into scarce assets that cannot be printed. They are shorting the banking sector's equity while going long the inflation that will be used to bail it out. Conclusion: the $24 billion credit line on January 2nd was a whisper. But in the canyons of Wall Street, a whisper echoes. It tells us that the collateral is straining. It tells us that the banks are not as safe as the stress tests suggest. It tells us that the Fed is already fighting the next war, even while the public is celebrating the end of the last one. The Soros trade teaches us one thing: do not listen to what the officials say. Look at what they do when they raise rates to 15% to defend a peg. The peg is dead. When they open emergency credit lines in the first week of the year to defend the banks are in trouble. The constraint is the debt. The incentive is to print. The outcome is devaluation. The only variable is timing and pain. If you want to understand the mechanics of this transition, you need to look past the headlines. You need to understand the plumbing. Subscribe to this channel